I spent hours learning about blockchain technology, so you don't have to. Phrase of the day is tokenized stocks. Tokenized stocks are something people can newly buy, sell, transfer, hold on blockchain networks. There's been a lot of recent big news about product offerings in this space. For example, Ondo brought hundreds of tokenized stocks and ETFs to the Solana network. Backed Finance has its X stocks lineup that's been trading on the Solana network for quite some time. And plenty of household names in the blockchain and crypto world have been talking about tokenized stocks. Naturally, one of the things people ask me is, what are they? Part of that, especially for those in the US, is like, do they matter? Is there anything different about these versus non-tokenized stocks? I can't predict the future, so I don't know what tokenized stocks will mean or look like, or if we'll all be trading them 5 years from now. So I'm gonna take a very simple explanation to tokenized stocks. At the most basic level, the concept of tokenized stocks is just to take the way we currently own companies, for example, in our brokerage accounts, and instead move those onto blockchain rails. That is, it's kind of just allowing people to take their stock exposure and move it, exchange it on a new backend for finance. That's all. Take the Solana network as an example. Things on the Solana network operate 24/7. They allow for self-custody, which I made a video about earlier. They have near instant settlement, and they allow people, for example, building phone apps to tap into a financial ecosystem a bit more easily, or maybe much more easily. I'll make a video about the concept of ledgers to explain this soon. All of this is a bit US focused, so I didn't even mention that things trading on the Solana network are global by definition. Following from that, the idea of tokenized stocks is to take the activity you might do on, for example, a Schwab or a Vanguard, have it instead all happen on the Solana network or another similar blockchain network. There's of course a massive existing financial ecosystem. The way people trade stocks right now, somewhat obviously, is not on blockchain networks. So how can this happen? Well, one example of how it's happened so far is that a company known as an issuer will go and buy that stock off-chain, so off a blockchain network. They then tokenize it. That is, they make it into a token that can trade on a given blockchain network. They hold on to the stock over here and let it move around on a blockchain network over here. This is the concept of one-to-one backing. So in some sense, it's just that simple. The concept is for someone to be able to invest in some stock exposure on a blockchain network with the features of a blockchain network. In order to do that, someone tokenizes the real-world asset. That's all the simple version, but there are some complexities here. As of right now, the regulatory apparatus around this, the legality here in the United States, is unclear. There's no obvious clear law in the books that says tokenized stocks happen this way and they're approved by the US government. Again, there's not that law. Some people might argue that existing law in the United States allows for tokenization. And over the last year, we've heard people at the US Securities and Exchange Commission, including its chair, talk favorably about the tokenization of stocks. We've also seen the SEC end investigations or send no action letters to companies playing in the tokenized stocks or equities world. But as of right now, I can't tell you this is exactly how US law in this matter works. It's just unclear. Part of that lack of clarity is around how issuers are allowed to work. For those who have used or heard about stablecoins, for example, US dollar coin, USDC, a lot of this might follow a familiar pattern. At the beginning, there was a bit of a wild west. People came up with all sorts of ways to provide quote unquote stablecoins. Over time, the ones that became the biggest, most trusted, did a couple things. First, they were backed by real world assets. They were very careful to try their best to provide credibility around that idea. That is, if it was a dollar stablecoin, they would hold on to a dollar somewhere else. The second is that they got some stamps of approval or developed institutional credibility with other companies in the space. It actually took until 2025 for US law to have specific legislation around stablecoins. A particular law, the Genius Act, passed in 2025. It now mandates that one-to-one backing. Again, I can't predict the future, but you could see the world of tokenized stocks following a lot of this pattern. But for right now, I find myself excited about 24/7 trading and self-custody. Definitely interested in what tokenized stocks can allow for beyond that, and also waiting for US law to provide some specific rules of the road. From a technical perspective, you could go right now on the Solana network using a self-custody wallet and buy a tokenized stock. There are listings for Apple, Nvidia, Tesla, some ETFs, and more. But is it technically legal? Are the issuers doing something a little bit risky? Can you be 100% certain that the issuer is doing things correctly? Those aren't questions to which I can answer. I think only time and US legislation can do that. I'll do a part 2 on tokenized stocks at some point because there's actually some more interesting behind the scenes stuff here. The TLDR is that there's no theoretical or technical reason that a company couldn't just have its shares be tokens from the start. That would mean you wouldn't have this concept of an issuer third party. The stock of the company would just exist as tokens. Will be an interesting deep dive for later.